The Stimmy checks are back.
Oh no!
So there you go. So I mean, remember the last time they did this, the M2 money supply just like jumped like 30% or something, like within the span of a month, like with some crazy amount.
So here's the game plan. This would be my guess. Gold and silver, like that's a spot to be. It's gonna rip. If he sends this out, if that's what he's gonna do, look for silver equities. Look for silver equities. They're gonna run. Okay, so they're gonna run big. Then you're gonna want to go to oil, and oil is gonna rip. Oil is going to rip, especially if they send out checks like this, because really what that is oil demand. Like, so you're going to get a big move in silver. It's going to rip really big, and then look next for the inflation sensitive assets. They're already positioned for this. It's almost like the insiders knew this was coming because they're all putting in double. I think the banks are probably stressed somehow from whatever. I don't know what it is. And this is a bank bailout disguised as $2,000 stimulus, because what they do is they give the money and it goes straight to the banks, because that goes into the accounts of the people, which is in the banking system. So it's a bank bailout, would be my guess.
You're watching CapitalCosm. My name is Danny. It is November 9th, 2025, and my guest today is Andy from the Finding Value YouTube channel. Andy, thank you so much for coming on, my friend.
Yeah, thank you for having me on, inviting me on. Love coming back and talking with you, Danny. Thank you.
Yeah, likewise. You're probably my favorite, or one of my favorite technicians that we have on the channel, and I know you're a big fan favorite here as well. So let's go ahead and dive right in. Everyone's favorite yellow and white metals. Go ahead and talk about gold and silver. It's been about 2.5 weeks or so removed from the top that we saw. What's your current prognosis on the gold and silver price?
Yeah, short term, we've had a pullback. I think it's just a short-term consolidation pullback. I don't think it's anything major where we'll be down for like it's not the end of the bull market in 2011 or something like that. So we're in a consolidation. Could it go on for a little bit? It could. I'm not saying that I know the short term here. Could we fire off and just keep ripping to the upside? I think that's a high probability as well. So yeah, I've got the chart there. We can dive in more towards the shorter term here. There's that consolidation. We are getting some. I can remove this. We are getting some buying pressure here, where we could be trying to bottom and start to try to turn higher. Usually, you dive in on the very short term. We've pulled on back here. We have a little bit of resistance coming through this section there. We've got the lows coming on up. So we're going to try to break at least this resistance area here and move on up. So once you kind of break that, create a higher high out of here, you could start into a higher high, higher low scenario where maybe we re-engage an uptrend. So I don't think it looks bad. We're just waiting to see if we can re-engage to the upside for gold in the short term. Now, I don't trade the short term. I do watch it. I don't really trade in and out. I'm more of a kind of the long term look at this stuff. So when I look at it, I look at it from this view, and then I usually put the 10-year on here underneath it, and that's the view that I view almost all of my investments from. Is we've got the broken downtrend, the upside move. So I think that this move here was in an increasing interest rate environment. It wasn't freely traded back here. You got that. And then we consolidated. This whole thing here is like a cup and handle, just like silver is. This is one big consolidation, and we've broken the consolidation. So this is game time. So whatever short-term pullbacks that we are experiencing in the short term here, I think they're just small consolidations. So that's the way that I view it. And
yeah, so
the same would go for silver.
So the correlation between the 10-year and the gold price itself, and if in fact the gold price is just consolidating and getting ready to have another leg up in the price action, does that imply that we're looking at some higher rates up ahead? Because if that's true, it appears to be proportional or somewhat correlating with the 10-year yield, which you just showed here on the chart. If the 10 years, if the gold price is breaking out in conjunction with the 10-year having broken out a couple of years ago, does that imply higher interest rates as well?
Yes. So I think that it implies higher inflation. Inflation impacts bonds where people want to sell bonds, increasing interest rates. As interest rates go up, so we're breaking out of this downtrend in interest rates here in the short term. And I think eventually we will break out. There's a big consolidation, I'll show you here. We will break to the upside of that consolidation on the bigger picture, longer term view. And what I mean by that is this consolidation there.
Mm-hmm.
This will break to the upside. And once you start to eclipse this 5% area, that's going to put pressure on the overall stock markets. So the S&P 500, the NASDAQ, when we start getting above 5%, it'll put pressure on that. Bonds are already selling off. That's why interest rates are going up. And then money is going to say, well, where do I want to go? It's not going into stocks because they'll be coming out of it, and it's not coming into bonds. So two asset classes are quote down, and then money's going to say, where do I go next? And it's going to go into gold, silver, and you're just going to see this continually go up for however long interest rates go up. And it will be the same dynamic that we saw. And I'm going to just use silver here, and just to show you guys, this is where I get the confidence to hold long term. So, so it's that this move there, and then the interest rate. So that's all coming again, and we're just starting to break out of that. And this is just silver, comparing silver. I've shown this before.
How can they sustain high interest rates if the debt burden becomes so gargantuan with a debt of $38 trillion? I mean, how are they going to manage that?
Yeah, so if they try to do QE and they try to hold interest rates down and keep the stock markets up, I think they're just going to blow these things through the roof. So that's why I'm in gold and silver, because I think they're going to try to do something like that because of the debt situation that they're in. But they don't determine the interest rates. The market's going to force them to do something. And then if whatever situation they're in, I mean, this isn't, there's situations that you're in, like you've got problem solution, and then you're in predicaments. I think they're in a predicament. It's not a problem solution. So they don't have a solution for what's coming. They're going to be stuck at managing outcomes. They're going to say, well, do we want to blow up the dollar or do we want to save the bond market? Like that type of situation, I think, is coming. And I don't know when, but it will come. They'll be forced with it. And then if they whatever they decide, they'll either let interest rates go up to save the bond market, or they transfer that pressure in the bond market into the currency, where they hold down interest rates and destroy the currency. Most of the time, I think governments will choose to destroy the currency and save the bond market. So they'll probably hold interest rates down with QE or something, and then just blow up the currency. We'll lose a lot of purchasing power in the currency, which then gold, silver, and all of these commodities and emerging markets, they're all going to just be sent to the upside. Last time they did, we saw similar things where the dollar fell. We saw things like emerging markets. I'll just use Brazil as an example. We saw a 20-fold increase when we saw the dollar get smoked. And we are in the beginning stages of that type of move. And you can see it across everything. So when we're looking at gold, it's not gold going up,
So,
It's
so what is
the
that? Is that Brazil?
denominator.
Is that a Brazil emerging market ETF?
Yep, this is Brazil here, EWZ, the ETF. So it's not gold going up, it's the dollar getting smoked.
Mm,
It's not necessarily EWZ going up, it's the currency exchange rates and money flowing from those currency exchange rates that is causing this. So if we were to do like the Brazilian real versus the dollar, you get this double bottom.
hmm
So here's your falling wedge. So that means that the buyers are equaling the sellers into the corner here. Then you get a bottoming pattern at the bottom here, usually a inverted shoulder, head shoulder, or a double bottom or something. Could be a triple bottom, whatever the bottoming pattern is, which we have a double bottom. And then I think we're going to head on up. And I mean, it's possible that we could do something like that to a triple bottom or something, but
What do you make of a
I,
DXY? What do you make of a DXY getting, closing in at 100? Because it did break through 100 earlier this week or earlier last week. It is Sunday right now, but it did break through
yeah,
100 and came back and retested it. Do you anticipate the DXY going up? Because it sounds like you would think it would be going down based off of this analysis.
yeah. So in the short term, I think the DXY is going to go up. In the longer term, BRL, sorry, BRL, Brazilian Real USD is going to go up. But there's a
Mm,
combination where you could have the Real go up against the dollar and the DXY go up at the same time because they are comparing against different currencies. The DXY is compared against a bucket of like euro and yen and whatever else is in there, and I think the Canadian dollar's in there too. And then the Real, I don't think it's in the DXY. So this could go up with the dollar DXY
mm,
going up too. So it gets a little bit difficult when you're looking at these like the DXY because it's all relative. It's not an absolute value.
right.
It's all relative.
It's pretty
But
much.
the
You
bull,
correct me if I'm wrong, but isn't it primarily hugely weighted towards the euro? So it's effectively just it's basically the euro USD ratio.
yes, yes, yen,
Or
euro,
sorry, USD to euro and the yen ratio.
yes.
So the
But
higher it goes up, it means the USD is up from the euro and the yen, and vice versa.
each of these currency exchange rate differences when the DXY falls, this was the 1970s to 1980 bull market of commodities. Here's another bull market down here. This was 2002 to 2008, 11. 11's the one there. And if this falls again, which I think it will with time, I'm not stating in the short term because we could still do something like that,
Mhm.
and then roll over. So we could get another one of these humps, so to speak, and do something like that. Um, then your bull market's going to come and it's currency exchange rates. So what happens with currency exchange rates is when money flows into dollar denominated assets, you get a move higher. Think of it as the market condition of low inflation, low interest rates. And that's what we had from the fallout of the real estate market in 2008. We had that big fallout. So this was the boom and
Right.
this was the bust. The bust was all here. And then we came up because we had no inflationary pressures driving from monetary debasement, and fiscal spending wasn't as bad as it is today. So we had low interest rates, low interest expense, all that stuff, kind of the Goldilocks period. And during a recovery phase of real estate, money flows into dollar denominated assets and pushes the dollar higher, and S&P goes up, NASDAQ goes up. And I think we're getting close to the end of that condition. So as you roll on over, inflation kicks up, interest rates kick up, and then money starts to flow differently in the markets. So if I were to kind of state my opinions here, currency exchange rates and the way that money flows in the system based off the market conditions of interest rates and inflation, it just changes the way that money moves.
hmm
And everything that I look at from a charting perspective, like say emerging markets and commodities, um, it correlates with that condition. So we get a consolidation in that certain condition here where this is emerging markets ETF that I'm showing you.
hmm
In that condition, we had a consolidation. And then after the consolidation, which ended, say, here in 2022, 3, we're going to break out to the upside. And this consolidation will turn into a launching pad where the dollar will weaken. Money's going to flow from dollar denominated assets to commodities, precious metals, and emerging markets and international funds and stuff. And this will break and be a launching pad. And last time in the 2000s, that was a different market condition than what we had today. Because in the 2000-ish area, it was a declining interest rate environment. It was in a consolidation. So when you look at, say, something like gold in relationship to the M2 money supply, you were in a base configuration. So the 70s was a big bull market with increasing interest rates. This is the gold price in relationship to the M2 money supply. This of 2000 to 2011 was in a basing period. So this is a base of a big double bottom. And then we're going to break out of this base and go into a really fun period for gold owners. That's what I'll say. It'll be a very fun period for gold and silver owners, commodity owner, asset owners, and stuff like that. It's not going to be like the 2000 to 2011 movement. And this is the reason why. The reason that this period will be different than this period is we had declining interest rates that were low that kept money in the stock market. Mm-hmm. So even though we went sideways in the stock market some, we didn't really break the big uptrend. So we went up, we went sideways, and then we went up again, and money stayed there more so than it will, I think, this time around. So if you were to look at something like the S&P 500 on a longer term scale, the bull market of lowering of interest rates, the ultimate bottom was 74, but the tailwinds really started in 1982, which is that area right there. And that created this gigantic bull market all the way up. Now, this here was the commodity bull market, but I think it was just a halfway pattern between 82 to where the top will be, wherever it ends up being. And interest rates are going to turn, they're going to go above about 5%. And this is going to start to chop sideways or pull back and go lower. When you get that, the combination of the declining bond market and the pressure that's going to be put on the stock market eventually, I'm not stating I know the exact top. Money is going to start to flow differently, and we're going to see a rush in there. And then all of our ratios that I track, like gold to M2 money supply, they're all going to go way up to the upper end, I think, of those ratios.
It's fascinating.
So that's kind of big picture view.
It's fascinating when you look at that gold to M2 money chart, because you notice that we topped out exactly around the same levels that we topped out in, 2011. So I mean, there you go. I mean, that is remarkable. So you don't anticipate things slowing down from here, given we hit that resistance line on the ratio chart. You can kind of you put the pieces together and you see this trend continuing forward.
Well, I see the trend going up, but that doesn't mean that I know the path. So what a lot of people, when I say I see a trend going up, that doesn't mean that it happens immediately and it will be continuous. So if this does something like this and then does that, it could do something like that for sure. Or it could loop back around like this. I'm not stating that I know with 100% certainty that this will occur, but this could be, it would be a cup and handle pattern if it were to do that. Because you came from the bottom here at 2000 and then you create the cup and handle on the ratio chart. But I'm not stating that that's what was 100% going to happen. So what's people
if you were to take that value we're at today and draw it all the way up to the peak of, what is it, an 80 or 79, how much of a gain would you be looking at? 164% gain from here.
Yeah, it'd
on.
be 163%, but that's the outperformance of M2 money supply. So if they go
Mhm.
vertical in M2 money supply, this will do a 2.6x increase on
Yeah.
top of the M2 money supply growth. So if they have a problem where they destroy the currency, which I think is going to be the case. Remember, I said they're going to save the bond market, destroy the currency. the this when this goes up, you could see a very big value dollar wise in gold. So it's not, oh, it's going to go up 2.6x from where we are today. No, you could go up 20x. It depends on what they do with the money supply. If they go vertical in money supply, then this will just outpace it. So you could, I mean, the dollar value is all kind of just it's all relative, I guess, because if they
Mhm.
start dumping money into the system and nobody wants to buy
Yeah.
bonds or stocks, then all that money is just going to go here, or a lot of it is going to go here. Maybe not all of it, but a larger percentage will go into precious metals than what it did in the last 45 years.
Well, it seems like after this past Tuesday, after the Republicans got trounced by the Democrats, President Trump's been going hard on um, pandering to the crowd, so to speak. He just recently announced today, I don't know if you saw the news, but $2,000 stimulus checks per person as kind of a tariff dividend thing. So, I mean,
Is it he's doing that?
yeah, he announced it today.
Oh, I didn't know that. I did
Yeah,
not know that.
the Stimmy
Oh,
checks are back.
oh no.
So there you
So
go. So I mean, remember the last time they did this, the M2 money supply just like jumped like 30% or something, like within the span of a month, like with some crazy
yeah,
amount.
so here's the game plan. This would be my guess. Gold and silver, like that's a spot to be. It's gonna rip. If he does, if he sends this out, if that's what he's gonna do, sounds like that's what he's gonna do. I didn't read anything about it yet.
He announced
Silver's a
on Truth
spot to be.
Social.
Look for silver equities. Look for silver equities. They're gonna run. Okay, so they're gonna run big. Then you're gonna want to go to um, oil, and oil is going to rip. Oil is going to rip, especially if they send out checks like this, because really what that is oil demand. Like, so you're going to get a big move in silver. It's going to rip really big, and then look next for the inflation sensitive assets. They're already positioned for this. It's almost like the insiders knew this was coming because they're all putting in double bottoms like this in fertilizers and oil and energy service companies. So March was uh, April and May were the bottom of a lot of these. So the game plan, in my opinion, if he is going to send this out and going to increase the money supply, um, silver and the equities, the junior equities, look for those. They're gonna go ballistic. Then it's going to be oil and a lot of these inflation sensitive assets. So if you want to try to time this, it would be the silver equity is what I would look at, and then I would look at energy. Right? Maybe you might see them move in tandem together, but that's kind of what I would look at because that's what happened in 2020. I played it. I actually, I got lucky to some degree. Luck. It's opportunity and skill gets luck. I had a very good return from 2020 to 2022. I 8x the entire portfolio in that time frame. And what I did is I went into the gold and silver mining companies. They went ballistic off that news. Very, very rapid increase, like a 3-4x in some of the companies in like 6 months, even 6 months to a year or so. Because I think it was April of 2020 into September, October of 2020, and then the oil stuff went ballistic after that. So we have a similar situation, sounds like, forming right here,
Hmm.
and that's the way I would play it.
So, order of operations: gold, silver, physical, mining equities, and then energy stocks.
I would do the equities, right? The
Silver equities. Okay.
silver equities specifically, and then I would look at energy.
Why silver?
Um,
Why silver equities? Why not gold equities?
so silver's gonna. So we're right at the 45-year cup and handle. So if I were to show you guys, like if this was the time to do it, this is the time to do it. We're right there at that breakout. If oops, if they're going to do this, Every time they print money, silver's like the reaction to this money printing. It did it in 2020. It did it in 2008, 9. I don't know if you remember back then, but they also did stimulus. George Bush sent out checks. And then gold and silver ripped off that 08, 09 bottom, which was right here. Since I got the chart up, that was right right here. Then where is it? Right here. So that's 08, 09, and then it just ripped. It was this great vertical shot. So I think maybe it's already pricing some of that in because it's going vertical, but I think we're gonna hit it here. I mean, there's a possibility if he does this and it's a decent increase of currency. I mean, I don't think the tariffs are funding that. I don't think he collected that amount because we're still running deficits. So wherever this money is going to come from, they can say it comes from tariffs, but
Well,
I think it's going to be expansionary. So
I'm going to do some quick math. How many people? I'm going to do some quick math in terms of how much it would increase the money. So, because he said $2,000 per adult. So, while
we got like
you talk,
100.
I'm going to go crunch some numbers in the background and see like what that would result in.
Well, we've got what? How many adults are there? Maybe 180, 90 million. I don't know what. Off the top of my head, 200 million. I don't know.
200. Yeah. So, as of 2023, U.S. adult population is estimated over $258 million. Oh, sorry, 258 million people.
Yeah.
Yeah. And so if you multiply that by 2,000, I mean, that's wild. 258 million times 2,000. That's $516 billion.
Yeah, and I'm sure there's other money going somewhere like into banks. They usually,
But the
if
thing
they
is,
print money,
if they send $2,000, $500 billion directly into the pockets of the consumers, that's going to be spent immediately. I mean, the money velocity behind that's going to be overwhelming. That's going to cause, I mean, that's what caused the initial wave of inflation.
yeah. So here's my guess. Take it for what it's worth. I think the banks are probably stressed somehow from whatever. I don't know what it is. And this is a bank bailout disguised as $2,000 stimulus because what they do is they give the money and it goes straight to the banks because that goes into the accounts of the people,
Yeah.
which is in the banking system. So it's a bank bailout, would be my guess. There's my my chess play there.
And you remember, they still have that income tax quiver in their arrow in their quiver, I should say. Remember when he was talking about ending the income tax not too long ago? I mean, they still have that if they ever feel like they're in trouble as well.
Well, let's do it. I'm all for that.
Yeah. All right, quick break here because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Click on the link down below in the description box and use promo code COSM10. Now let's get back to the video. I mean that would be, that's even better than it. That's, to me, that sounds even better than a stimulus check, because a stimulus check, you still have to, it's a blood transfusion from one arm to the next. I mean, you're still going to be, you're going to drop blood in the process. Whereas just cutting the income tax is just, there's no degree of separation between doing it and actually the action itself.
I mean, you could cut the IRS, right?
Yeah.
You could do a lot of stuff, I guess. But yeah, we'll see. I haven't read any information about this, so I don't know what exactly the package entails. If it's just sending $2,000 checks, maybe he's doing something with bailing some other stuff out. Usually, there's money that goes somewhere else as stimulus checks come out, but I don't know the full extent of it. I haven't really seen it yet, so
So here it is. I'm going to pull it up just so we can read it.
sure.
So, all right, this is from his Truth Social, and why is it not showing? Okay. All right, so this is from his Truth Social, and he says, "People that are against tariffs are fools. We are now the richest, most respected country in the world with almost no inflation and a record stock market price. 401ks are our highest ever. We are taking in trillions of dollars and will soon begin paying down our enormous debt, $37 trillion. Record investment in the USA, plants and factories going up all over the place. And here's where it says it. A dividend of at least $2,000 a person, not including high income people, will be paid to everyone." So there you go.
Yeah, I like how he stipulates at the back a dividend of at least 2,000 a person, not including high income people,
Yeah.
will be paid to everyone. Well, it's not paid to everyone. It's
Yeah,
paid to people
yeah.
who don't have high income.
Yeah.
That's an interesting statement that he makes in that entire thing there. He first says that people against tariffs are fools. I think that's kind of funny. And then he says all this other stuff about why we're so good. Do some bragging behind it.
So yeah, Andy, I mean, you make a great point. He's talking out of both sides of his mouth. Pretty interesting to see nonetheless. But if the last round of Stimmy checks, which were only $1,200 a pop, these are $2,000 a pop, was any indication, that money is just going to get injected right into the banks, and it's going to be spent as immediately as you could expect. I mean, the money velocity behind these things, behind this injection, is going to be pretty fast. So, anything else you want to talk about, Andy? I know we also talked about before we hit record that you want to compare, and you had some interesting insights about NVIDIA and
Yeah.
copper. So let's go ahead and take a look at that.
Yeah. So we can, and I'll share here real quick. All right. So this is NVIDIA, and I know people are going to say, "Well, why am I showing NVIDIA? Why does it matter?" Well, keep in mind the everything that gets traded in the market is between people, and that's herd behavior. So it creates patterns, like this pattern here, where the way that it moves, the pattern that it creates, is an extension of the herd's psychology. And I was talking about this on a Q&A session that I brought up, and I said, this here is when the commodity bull market was progressing. Technology went into a consolidation phase. We just were coming out of a consolidation phase for commodities. So what happens is commodities will go up, I think, over here, and the consolidation will be here. And then NVIDIA will, I think, eventually chop sideways and do a consolidation similar to this. So this is one market condition. This is a different market condition. This condition is the same as this one. So during that consolidation of NVIDIA, which is this pattern here, that's what this is here. It's that consolidation.
Mm-hmm.
We're consolidating in a lot of these different commodities. And I'm just going to show you copper and the way that NVIDIA consolidates on top of this. So this is the price of copper futures price.
Okay.
This is the consolidation that we went through. And this here is about to go to another level. And I just kind of put a guess of where that level is. But this is NVIDIA. This is the NVIDIA's, the herd of humans trading with each other in NVIDIA overlaid on top. Now I'm gonna stretch this out a little bit just to show you kind of the pattern that the herd is creating here. Do you guys notice anything? So if I'm just going to put it kind of above so you guys can see. This three hump consolidation is the same as the three hump consolidation that we've got going on here. This lead up pattern is this lead up pattern here. And we're coming, so you guys understand the cycles that I talk about. So it kind of gets you guys the right mindset in order to hold the big long term. We've got the consolidation, and this is NVIDIA, completely different of copper. And people are going to say, why are you comparing the two? Because humans are trading this, and it's the extension of the psychology of the herd. Consolidation, NVIDIA from here did a 500 bagger. I'm not stating that copper is going to do a 500 bagger. I'm just stating that it went up a lot. Copper's got the same setup. It's got that lead in upward move. And this is going to be the big bull market move. We're right at the beginning stages of that. And this isn't the only commodity that exhibits this type of behavior. You can see that gold had something similar, cup and handle type consolidation.
For those who can't see the chart, Andy, what does that take us to a copper price of, if you just based off that pattern?
So the way that I would use it as a projection, I'm going to use this as a projection. So I'm going to take this move here, right? And then I'm going to blow it up. Now I'm going to get a ridiculous number here. So don't hold me, so if I just put it here and I do this, it's going to be like 18 bucks. If I try to get the size of this fractal pattern here, like this, see how that's the same type of movement here. I get a price that goes to like way up to some ridiculous number.
And that's to what year? Where does that top out at? What year?
Well, to 2044 at $680 a pound.
Yeah. I mean, that's not too unbelievable, right? That's like what, 17 years from now. So
what this is stating though, is I'm not charting copper here. I'm charting the devaluation of the dollar. That's really what it is. Because if this were to play out like that, and I'm not stating it is, I don't want to come off as crazy, even though I think this could be a possibility. Go look around and you look at, say, something like silver. I'm going to just go back and don't focus on the pricing. Focus on the size of the charts. And when you look at, say, something like this big cup and handle, and then you start to project things up and whatnot. And I know I've got crap all over, but you start getting these gigantic valuations that are multi-hundred. It could even be $1,000 an ounce. Now, people are going to say, well, I don't understand. I can't fathom that type of move. I don't understand what you're saying here. How can we get to 1,000? How can we get to 500? It's not silver, guys. It's not copper. They're all suggesting that the dollar is going to eat it. That's what that's suggesting. So if it makes you feel better or it's easier to handle, it's the dollar having the issues, not silver and the supply-demand characteristics of silver. Even though there is supply-demand characteristics that are positive for silver, it's dollar denominated. All these are measured in silver divided by dollar. It's a ratio. Right. And the ratio is priced in dollars. Now, if I were to take, let's just do XAU to have a cleaner chart, because I don't think I have as much on this one. If I were to take this, and I've got we'll do an experiment here. So this is gold priced in dollars, right? And people are like, okay, I get it. If I put this in Japanese yen, you're going to get a different looking chart. And it's going vertical, but the price move may be at a different rate of change. Now, if I put it in something else, say something like the Canadian dollar, we get a little bit different looking chart. So it's not the same exact chart, but I mean, look at this thing move from $500 in 2002 to 5,649. Is gold changing here, or is it just different ways of pricing gold in
Right.
different currencies? So what I'm saying here is the currency, which this one's in the Canadian dollar because I swapped it up here, even though it says USD here. It's the currencies that are the issue. And the way that these things move, if I were to pull like a Canadian dollar USD and see how this was the last bull market in commodities, it's not commodities themselves necessarily, it's currency exchange rates. And yes, there could be pressures that build in commodities that create these currency exchange rate differences. You could maybe argue that, but what's coming in the setup, whatever the reason is behind it, it's all lined up in a falling wedge ready to break here at some point. And it looks very similar to the same setups before that went, the fractal patterns that were
Hmm.
created. And if you sprinkle in the other currency exchange rates like BRL USD, African Rand USD, and we can go over that real quick too, just to show you. It's like these things are all lining up for a big exchange rate currency difference. The way that money flows. So money were flowing into the USD, and it's going to be flowing out of USD as these go. And it's not in one chart; it's in all of them. I can pull up the pound sterling. That's broken out already. The USD is going to get hit, is what I'm saying. And commodities, energy, precious metals, and then the other markets in the world are going to go up. It would be my estimation because of these currency exchange rates and how money is going to flow in the system.
Right.
So for example, we could take the Chile ETF, and there's the squeeze up and the
Would you
breakup.
anticipate? Would you anticipate? Sorry to mean to cut you off, but would you anticipate the highest outperformance coming from these commodity-rich currencies like Australia and Canada?
Yeah, so I think the most leveraged ones are the ones that have the most commodities in it. So I think like the Canadian dollar, Australian dollar, and then maybe the African rand. I think
Mhm.
the African rand could, as weird as it sounds, could do crazy stuff. Like, and the companies that are there. So like if we could do like I just talked about South Africa, right? The African. So let's go South Africa ETF, EZA, and then you can kind of, I've got my awesome drawing here. Here, I'll just clean it real quick here. So what I see here is you get a consolidation. This is the 2020 bottom. You can see the 3-hump consolidation here. So that's your consolidation right there. You're going to put kind of a trend line through here, going across, and let me kind of squeeze it up a little bit. I'll say that this here is your consolidation there. So you got this kind of resistance zone. And then we're going to, in my opinion, get up all the way up to the top here and then rip and use this as a launching pad. It's the same as emerging EEM. And it's the same as EWZ and ECH and all these different emerging market currencies. It's all in process of doing that. We haven't broken out yet. Maybe there's still a little bit more dollar strength in the very short term before this unleashes, but
Mhm.
with stimulus checks being put out there, if money printing occurs, which I think it will, we're going to have. We're going to have all these start to break out because what money printing is just inflation. That's all it is. So if
And
he
then
hands out $2,000 checks, it's just demand for crap.
and then
That's what
and
it
then
is.
you also have the 50-year mortgage thing that he announced the other day as well. I mean, that's going straight into the banks too.
Yeah, so what he's trying to do, I think, with that is get the real estate market ungummed. It's all gummed up right now. And that's going to allow a little bit of the affordability pressures to, I think, be relieved. And then money is going to come into the system from more so from bank lending. So that's another avenue for money creation. Money creation can be fiscally driven government spending, and I think he's trying to transfer it to monetary bank lending to get that ungummed, all ungummed up is what I'll call it.
I
It's
mean,
all gummed up right now, and sales are way down. He's going to try to reverse that.
and that's another tailwind for gold and silver prices too. No,
yes,
and then
commodities.
And commodity, because you also one of the things that you always talk about is the relationship between the commodities market and the real estate market. And so how do you anticipate these 50-year mortgages to affect the commodities market? It sounds like they're going to be bullish on the commodities market.
Well, if it in fact increases bank lending, so if it does, then it will be bullish, and you will see home builders should turn up. You should see regional banks strengthen, that ETF regional banks.
Mm-hmm.
And then usually with the home builders, that also is a function of the economy. So we were seeing a little bit of a slowdown in U.S. construction employment, which let me see if I can find that here in U.S. construction employment. It was kind of turning over and slowing down a little bit here. So this here can be a leading indicator of a recession or slowdown. So we were seeing this kind of roll over a little bit, and now you're seeing stimulus checks and a 50-year mortgage. That I think they're trying to keep this from rolling over. I think this is usually where unemployment comes from, and this is where the slowdowns come from. When the economy slows down, you get construction employment's a huge cornerstone of employment. So when these roll over, you generally get these recessions in the market here. You can see that this one wasn't a huge one there. The rollover there, and then we're starting to kind of roll over there. So perhaps they're seeing this and they're saying, reliquify the banks, throw stimulus out there, and let's put this 50-year mortgage to get the affordability going here. This doesn't mean that we get a 1929 style crash that I see posted all over Twitter. These people need to get slapped. The 1929 crash would be analogous to this, because that would be bad loans in the system going bust in a deflationary type collapse. We don't have that setup. So the 29 crash, people, which was really a real estate bust in the 1920s, I don't see us doing this. They would prevent that from, I think, occurring. They have lower interest rates, do QE, do whatever. So,
I mean, but the signs are all there. 50-year mortgages,
yep.
$2,000 stimulus checks, lower Fed funds rate. Yep. I mean, anything else I'm missing? Is there anything else that we didn't talk about?
Well, those are pretty big
ones right there. I mean,
those are the pretty big ones.
Those are three big signs. Yeah.
If they do this, what I would maybe try to look for, XHB, the home builders, which has been crushing it here. There is a possibility that this thing's like a Livermore accumulation cylinder. And if they can get this going, I mean, maybe we break out and do that. If this occurs, I think what you'll see is you're going to see, just like before, emerging markets are going to rip, precious metals will rip, energy is going to rip. And when you look at like the energy complex, because these are all interconnected, we can do crude oil. We are in, I like viewing it from the candlesticks. So we're in, this is the consolidation, that 1, 2, 3 hump consolidation that I was showing in emerging markets and Africa ETF and all those. That's this consolidation here. We're sitting on top of it, squeezed up into the corner here, ready to break higher, which then we are going to see a move out of this area, just like copper is going to do, way up here into multi-$100 energy. So it's all primed for that to occur, and perhaps the smart money knows this is coming. We're in a similar situation today than what we were at the 9/11 2001 period. So that circle is this circle here. and it's gonna rip. What I could do, if you want to see a projection, if you guys like projections, I think that this here, if it were to do the same as before, um,
Oh wow.
so I get a projection of something like, I don't know, $500-$600,
And
something
what
like
year
that.
is that? What year is that being projected on?
2035.
Okay. I
If
mean,
it
yeah, I
were
mean,
to,
like in 10
you
years,
know,
anything can happen in 10 years. Like it's not that
it's
it's a crazy number, but like put in the context of the time that it takes to get there,
yeah,
it's not that
and
unbelievable.
keep in mind, it's not, people are they're gonna say, how can people afford it? What I'm telling you is we need to have less people afford it. Like, I think that's what's coming. And it's dollar driven. It's weakness in dollar. Think of it that way. Not
Hmm.
not oil. It's copper, oil, silver, gold, they're all doing it. And this move that is coming, gold is already pricing it. That's the move that's coming. You're just moving that chart here, which is, this is front running it. This is liquidity and money creation real time, is going to be transferred through the economy. And then that, when it comes through the economy, it's going to pass through. And if I were to, let me just grab this to make my point. It's going to come through the economy, and I will grab this. So that's that gold chart. And then copper is just lagged behind it with our cool things here. So what this is, and I'm just gonna do this. So that is, do you guys see the way that this is moving here?
Yeah.
This is gold overlaid on top of copper. When that goes through, we're gonna get a price of like $13 or something, 12.50. So this would be my guess. I think that copper is gonna reach 12.50. That would be my guess, because this is an actual squeezed up pattern of gold basically front running the liquidity. And then this gold price will also go into the oil price here. And then we can, it may not be as clean of a pattern here. And this is going to be a little bit more volatile. And I'm just going to do this whole thing like this.
Hmm.
But this here is what that is. This pattern there, and then this is the cup handle portion of it. And then I don't know, maybe we go multi-$100, something like that, $300-$400, whatever it is. So these patterns all kind of overlaid on top, and I know I'm stretching out the gold one, but on top of oil. But that's what I think. I think these are all interconnected, and in the currency and interest rates are what interconnects them all.
I see. Well, great stuff, Andy. Fascinating and insightful interview as always, my friend. And anything else you want to talk about that we didn't get into before we bring this home?
No, I think that covered quite a bit, and hopefully it helps people get an idea of what's coming.
Awesome. Well, hey, thank you so much for coming on, my friend. Where can people find your work if they want to see more?
Yeah, you can follow me at Finding Value Finance on YouTube, and I also have a website that I share my opinions and my portfolios and stuff, and how I'm playing this through finding-value.com. And specials a coupon code you can use if you'd like to sign up. Um, we have both monthly and yearly memberships.
All right. We'll have the links to your website and YouTube channel down below. So be sure to check it out, guys. And if you got value out of this content, hit that like and subscribe, comment down below. Go, Andy, go. Let me know if you agreed or disagreed on anything. I do, in fact, read all the comments. And by liking, subscribing, commenting, doing all the YouTube stuff, you do help in pushing this video up in the algorithm as well as this channel. So if you'd like to support us, it's a nice and easy and free way to do so. And a little bit does go a long way. But if you'd like to support us monetarily, consider becoming a member on Substack at capitalcosm.substack.com and get access to all my stuff early and ad free. Or you can check out our good friends over at the Boolean Standard Pro. Get gold and silver at cost, becoming a member at the Bullion Standard Pro. We have a special 10% discount down below. So with all that said, thanks for watching, guys. I'll catch you later. Bye.